Shares of Peloton have had a nice recovery recently. Shares are up about 9.6% over the past month as I'm recording, but the year has been pretty rough. Shares are down about 25% since the first of the year, but a lot has changed at Peloton over the past couple of years, and the company does have some momentum on its side. So I want to go through a few things to look at for Peloton, why this recovery in shares may actually last long term, but it could potentially take multiple years for this new strategy to really play out. So let's go through all the details of what's going on at Peloton today. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. Check out fool.com/ASYM for their top 10 stocks to buy right now. And first, I just want to show a couple charts that show where Peloton stands financially. And this is a look at the company's revenue and net income. You can see that revenue peaked in 2021. They have a little bit different fiscal year, over $4 billion in revenue. And that is now down to about $2.8 billion in revenue. Now, I want to caveat this a little bit. In 2020 and 2021, a lot of the growth in revenue came from selling more bikes. That is a hardware sales. And that's actually what got the company into a lot of trouble, is they pushed as many bike sales as possible and then eventually found out that they didn't have enough demand for the bikes that they were bringing into the country. So they had to write a lot of inventory off. They've actually reduced prices pretty significantly over the last couple of years. So this is really a razor blade model, except they were losing a ton of money on the razors and not making it up on the blades. So the strategy shift over the last couple of years has been to move to selling fewer bikes, working with more third parties, and trying to grow the subscription business. That subscription business is going to be a more traditional subscription business, 70-80% margins. And then you can spread your costs to film a class across millions of subscribers. This is why Peloton has gone to adding more and more types of classes. It isn't just a bike company anymore. You can do strength, you can do meditation, yoga. There's, I believe, nearly 20 what they call modalities of classes that you can do right now, any different length, any time of day. So they can do that because they have millions of subscribers. So they've really leaned into that, become more of a streaming company and a software company. But you can see that the net losses have continued over the last year, about $1 billion in net losses. If we look at a couple of other metrics that are important, cash, long-term debt, and free cash flow, this also shows that Peloton is not in a stable financial position today. Negative free cash flow. They have an increasing amount of debt. That's partly due to the restructuring that I talked about earlier, and the cash levels declining. So not heading in the right direction, but let's get to a little bit more details on where there is some improvement in the business. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This is a look at some of Peloton's most important metrics. And I'm going to just highlight the big numbers here. The number of members is down slightly, about 4% year over year to 6.4 million, but that's not necessarily what we want to watch. The biggest number is going to be the paid connected fitness subscribers. This is going to be the people paying the full, I think it's $44 a month for their monthly subscription. That was actually up 2% year over year to 2.964 million, almost 3 million subscribers. Then there was app subscriptions. That was down slightly to 763,000 people. Over the summer, what Peloton did is introduced a new app and a new pricing tier. So we'll see if they change the way that they report this and the trajectory, because I think ultimately this number is going to be what we're going to want to watch long term. But if we go to the revenue piece, the connected fitness products revenue, remember, this is the hardware. This is what I was talking about. You don't necessarily want this growing all that much. $180.6 million, that was down 12% year over year and 18% quarter over quarter. But there was actually a small profit, $5.7 million. That's because this last quarter was actually plagued by a recall. The bike seat, basically the post, Peloton just sent out a new post to people who had a lot of their bikes. So there was a very expensive recall, but you can see that this is now basically a break-even business. Gross margin is just 3.1%. What we want to see growing at Peloton is this number, $415 million in subscription revenue. And then the other thing is this number, the subscription gross profit, 67% gross profit and subscription contribution margin. that's basically more like the cash flow number, is 72%. So you're more like software type margins. And this is what you can really leverage if you're a company like Peloton. Like I said, you record those classes one time and you can distribute them millions of times if there's that much demand. So the bigger that subscription base, the better it is for the business. This is why you see Peloton going into lower price points with the app service and even offering some free subscriptions for the app, because the bigger you make that user base, the more valuable it is as a business and the more you can leverage this, get operating leverage on the business. That's really what you want as a software company. And that's what Peloton has become. So as a result, you add these two things together and you get gross profit actually increased 31% year over year to $285.4 million in the most recent quarter. So more than $1 billion in gross profit on an annualized basis. Operating expenses also heading in the right direction, down to $417.6 million in the most recent quarter, down 29% year over year. And this is as they cut a ton of operating costs. They closed down stores, they cut down overhead on sales, general and administrative, just all kinds of cost cutting happening on that operating side as they're keeping that subscription business growing. So this is what you want to see as Peloton transitions from being more of a hardware company to being more of a software company. The net loss, obviously $159.3 million. We would like that to see that be positive, but this is going to include a lot of non-cash expenses like stock-based compensation. So at least a proxy for how the business is doing is adjusted EBITDA and free cash flow. You can see that adjusted EBITDA is now positive. Take that with a bit of a grain of salt, as this number always should be taken. The challenge for Peloton and investors is we really only get updates on how the business is doing once a quarter. We don't have a great idea of how many subscriptions are being added. You could look at things like how many classes are being taken, but that's volatile over time. So the stock has done really well recently, in part because the market has done really well. And this is a high beta or high risk stock. So you would expect as the market rises, Peloton is actually going to rise a little bit more just because of those general market dynamics. In short term, that's really what's driving the stock. But long term, what's going to drive the stock is the recovery in the business and the move to this subscription-based business and this SaaS model where you're trying to attract subscribers who are going to pay anywhere from $5 to $10 a month to $44 a month for the full access to all of Peloton services. So I think the company is moving in the right direction. They have a lot more modalities or types of classes in the ecosystem. They have all kinds of times, all kinds of instructors. And as someone who's been using Peloton for a few years now, you can really tell the increase in the supply of content available. And that's really what you want to see. This is a little bit like Netflix. It's no coincidence that the CEO of Peloton, Barry McCarthy, was the CFO of Netflix when the company was in its growth phase. So can he replicate some of the things that made Netflix really successful, increasing the amount of content, increasing that subscriber base, and doing it on a profitable level? That's really what they're trying to do. I wouldn't expect to see Peloton be profitable in the next year, but steps in that direction, growing that user base, growing the number of people who are subscribing to the app and don't necessarily have a Peloton device, is really going to be where the growth is. And then long term, I think we could ultimately see Peloton be the software service for a lot of other hardware companies. Why doesn't Nautilus access Peloton or really any piece of hardware? So that's where I think this company is ultimately going. It's really more of a software company. And a lot of the competitors in this space have fallen by the wayside. They made a deal with Lululemon, which actually took Lululemon's classes, that mirror product, off the market. Now Peloton is going to be supplying those subscribers with content for workouts. So I like what the company is doing strategically. We haven't yet seen progress on the bottom line, but that's what we're looking for in 2024. The company's already in fiscal 2024, but in calendar 2024, I think we should see more progress with growing that subscriber base and the amount of margin that's coming out of those subscriptions. So that's what I'm keeping an eye on with Peloton. What do you think about the company and its trajectory? Do you think it's a buy now? This is a stock that I've been adding slowly over time, but don't want to get too overextended because it's absolutely still high risk. But leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.